If you trade crypto in the UK, you need to listen up. From the 1st of January 2026, HMRC will have an automatic feed of everything that you do in crypto. That means they can track all of your ins, your outs, your fees, your profits, your losses, every single transaction, no matter how big or small. They'll also be able to link those transactions to your cold storage wallets, your hardware wallets, so there's nowhere to hide anymore. And the worst part is that your tax bill is essentially preloaded in this system before you've even hit submit on your self-assessment. Now, just to be clear, I'm not a chartered accountant. Nothing I say here is actual personal financial advice. All I've done is I've taken HMRC's own manuals and documentation and turned them into plain English to display to you on this video. This whole update to HMRC's caused a wave of questions. So in this video, I'm going to go over the 15 most common questions I'm hearing on this whole HMRC update. Let's get into it. If you're new here, my name's Lewis. I help investors make better investing decisions and as a result, make more money. And seeing the shockwave of the response in the last video in this series about this topic, I discovered that people in the UK have a ton of questions about this. So I've read the comments and I'm bringing you today 15 of the questions people are asking about this new HMRC impending update in 2026 for their crypto asset reporting framework update. That was a mouthful. In January 2026, HMRC will be switching over to their new CARF system. CARF stands for Crypto Asset Reporting Framework. And this will be a daily automatic feed of the data from all the exchanges into HMRC's system. And that gives them full visibility over all of your trades, your fees, your ins and outs, all of it. Now here's the thing. CARF itself isn't new. HMRC's actually already had the capability to reach back into your accounts, and they do this by doing something called a Schedule 36 notice, where they can request from exchanges specific data about specific people. Now, they can actually go back 4 years as standard of all of the data of the last 4 years. They can go back 6 to 12 years if they think you've been careless, and they can even go back as far as 20 years if they think there's been a deliberate evasion of tax. In other words, they've always had this ability to get that information. The difference is it always took a manual request. From January 2026 onwards, that manual request becomes automated, and all of that data flows into HMRC's system daily. And because of that, the first question people naturally ask is this: if HMRC already has all of my crypto data, do I still need to file a self-assessment? Yes, you still need to file your own self-assessment. Because even if they have all the numbers, they don't have all the context. And context is actually really important for how you treat tax in the UK. So they can't really see your fees or anything, or like the gains or the losses that you've had, or whether you've actually utilized your £3,000 capital gains tax-free allowance, for example. They don't have that context. And so the new system essentially lets them just check your work. It doesn't do the job for you, so you still have to do your own tax return. It's kind of like having a bank statement. You know, the bank knows all the money you have and what's in the account, but they don't know why you spent this amount of money on this thing. They have no context for all of that. But the concerning part for me is that because they're looking over your shoulder and seeing what you have, basically, they can keep tabs on whether people should have probably declared tax or not. And so they're keeping a watchful eye on people who aren't actively declaring their tax and punishing people for doing that. I'll touch on that a little bit more later in the video. And that raises another obvious question that people keep asking me. Is there a tax-free allowance on crypto in the UK? And the answer is yes. It's small, but it does exist. In previous years, you had £12,000 tax-free allowance. Then it moved down to £6,000. And now, with the current government setup, it's down to £3,000 in capital gains each tax year before you pay the capital gains tax. And that's the profit after all the fees and everything you've paid. It's the pure profit. So as soon as you go over £3,000 in pure profit, they start taxing you for everything over £3,000. And if you earn income from crypto, like from staking or mining rewards or anything like that, you actually get a £1,000 trading allowance. Anything above that trading allowance is then actually treated like income and taxed like income. And by that, I mean taxed almost like wages. So in the UK, it's very small amounts are actually tax-free. Everything over that is treated. You have to report and you have to pay. And this is where I think people get very nervous, because HMRC can actually look back over your history about whether you should have paid tax in the past or not. So the question becomes, if I have underpaid crypto tax or I haven't declared tax from the past, is it better for me to tell HMRC first or wait for them to find me? And it's actually very clear in the documentation about this. You basically need to come forward and tell them, because HMRC calls this a voluntary disclosure. And if you tell them about unpaid tax from previous tax years, they'll penalize you significantly less, between 0 and 20% extra of the tax that you haven't declared before. Whereas if you let them come to you, you're paying anywhere between 30 and 100% extra as a penalty on top of the tax that you owed from previous tax years. So they can go back 4 years. Normally, that's pretty standard. They can go back 4 years of all of your crypto history, or they can go up to 6 to 12 years back in history if there's some red flags or they're a little bit concerned, and they can go back as far as 20 years in the past, which crypto wasn't even around 20 years ago. Well, it was, but barely. And they'll go that far back if they really believe there is some effort to evade tax. So if you know that you haven't declared taxes for previous tax years, it's better to just do this now before January 2026, and you'll be penalized way less than if you just let it go and let it go and let it go. Because at some point it turns into, are they actually deliberately trying to evade tax? Well, let's go back 20 years in all of their crypto history and see what else they're not paying. That's just a way worse situation, and then your fees are more as well. So that's the penalty side of things, but there is another angle that people are worrying about as well. Can HMRC actually link my cold storage wallet or my hardware wallet to me? How do they know that my cold storage wallet is mine? HMRC can actually quite easily link to a cold storage wallet simply by following the trail. So when you buy or sell on a big exchange, you do something called KYC. This is where you give them your ID, your name and your address. You give them that information. And so if you ever move crypto from that exchange that you've done the KYC on, and you move it to an external wallet, a hardware wallet, a cold storage wallet, HMRC will look at that trail and just make the assumption that that wallet, that cold storage wallet, is yours. And so then they can trace it from the cold storage wallet. If you send it somewhere else, they're tracking that. They're basically following the trail. If you've engaged at all in a KYC exchange, or any major exchange, and you've had to give your ID, name and address, they can follow that crypto anywhere. So the only time that they can't trace it back to you is if you've bought a cold storage wallet and you've only ever engaged with crypto on a non-KYC exchange where you don't have to give them your ID. And then if you've only ever moved non-KYC sourced crypto into the cold storage, that's the only way they wouldn't be able to track it. But non-KYC crypto exchanges typically have a higher risk of you participating there. But potentially, if you're just buying crypto on non-KYC exchanges and only sending that crypto to a very specific cold storage wallet, there's not really any way for them to trace it back to you. The KYC, the giving them your ID, your name and address, is the thing that links you to all of the other cryptos that you hold. And so that naturally, and in a way I've just answered the question, do non-KYC exchanges or privacy crypto coins, for example, hide your crypto from HMRC? And although I think maybe in the previous answer I gave you a little bit of hope here, the reality of the situation is that no, non-KYC exchanges or privacy coins are going to be able to hide your crypto from HMRC. And here's why. To get use out of that crypto, in some way, shape or form, you're going to have to move it back out of the cold storage wallet and into a bank. And as soon as that happens, questions, alarm bells start going off, and they start asking, where did you get this money? And you've got privacy coins like Monero or Zcash, for example. They can muddle up the journey a little bit, but eventually the money's got to come out. It's got to come out into the bank. You have to spend it at some point, right? Unless you're just holding it forever and not going to use it, which I would question, like, what's the point there? But as soon as you swap those cryptos back into Bitcoin or Ethereum or XRP or anything, it becomes immediately visible again, and they can just follow that trail. So in many ways, those things don't remove tax from your bill. Instead, when they become re-visible, HMRC will just raise all the red flags and think, what were they doing with all of that? Were they trying to evade taxes there? Oh, let's look 20 years back into their history to see what else they've done. That's just not a situation you want. Then another question people are asking me here is, if I move abroad, will I still have to pay my UK crypto tax bill? And so moving abroad can in fact lower your tax liability, but only if you really stop being a UK resident. And so there's a whole criteria of things that you would have to do to truly become a non-UK tax resident. And it really means you have to cut all of your ties, your family, any properties that you own, your job, everything has to move. And not only that, you have to be away for more than 5 years. If you return to the UK after 4 years, they can look at actually all of the tax that you should have paid in those 4 years and actually charge you for it all when you get back. If you come back within 5 years, that's the type of thing that's going to happen. There is a name for it here. Yeah, it's called the temporary non-residence rule. So if you are going to travel away and move away for tax reasons, you have to make sure this is part of a long-term lifestyle change, as in more than 5 years at a time, because otherwise you're just going to get taxed even worse when you get back. And so another thing I've been hearing is about the messiness of the reporting and how difficult it is to kind of do the maths around reporting. And one big question that people have been having is, how do I calculate my crypto cost basis in the UK across different exchanges? And so a cost basis is basically an average price that you've paid for any given specific crypto. And that gives you an idea of how much, where your profit position is or where your loss position is. If you know when you bought and you know when you sell, then we can calculate profit or loss. So HMRC uses something called share pooling rules. And that means they don't just look at any one exchange at any given time. They actually pool all of your buys and sells for all the cryptos across all the different exchanges. So here's how it works in simple terms. If you buy and sell the same coin on the same day, those match together. If you sell a coin and then buy it back within 30 days, that new buy is linked to the sale. Then third, everything else goes into one big pool where the cost is averaged out. So for each coin, Bitcoin, Ethereum, XRP, whatever it is, you end up with one average cost that HMRC applies across all of your accounts. And then, of course, there's a big nightmare scenario that can take place. What if an exchange goes down, or they delist your asset, or the crypto that you actually have goes to zero? What happens if my crypto is delisted or deemed as worthless? Can I claim that back as a loss on my taxes? And this is actually quite nice. Yes, you can. You can still claim a loss if an asset is deemed worthless or delisted. And the way you do it is with something called a negligible value claim. That means you basically tell HMRC that it's worth nothing. You show them the screenshots, and you need to essentially have proof that this project had failed or was delisted. And sometimes exchanges release notices of delisting. So you need to screenshot all of that. You would submit it to HMRC, and HMRC would basically, if it's legit, accept that it went to zero and allow you for future tax returns or the current tax return to harvest the loss that you saw in that crypto. So that's quite nice. You can look back at all the assets that have gone to zero for you in the past, and you can actually claim those losses in future tax bills if you haven't already. On a similar note, what about coins that you didn't even lose? What about cryptos that were stolen? Can I claim a tax loss if my crypto was hacked or stolen? And it's like one of the biggest shames in the whole system here. Sadly, no, you cannot do that. HMRC only lets you claim a loss if you actually dispose of or sell an asset. If it's stolen, you no longer own it, but you also didn't sell it. The only time you can claim the loss is, like I said previously, if the coin becomes worthless. Then you can make that negligible value claim, just like we previously talked about. So hacks and scams hurt incredibly, but they do not reduce your tax bill. And naturally, with all of the complications in all of this, people start asking about tools and professional help. So what is the best UK crypto tax software? And how do I find an accountant to help me with this? So yeah, there are loads of tools that help make all the maths a lot easier. The one that I recommend in the UK is Coinly. They allow you to connect to all your exchanges, pull in all your trades, and they actually automatically apply HMRC systems and treat it properly, all kind of automatically. There's some work involved there, but for the most part, they apply the HMRC pooling rules for you. Now, I do have an affiliate link for Coinly, but only because I think they're very good. The link to Coinly is going to be in the description. It is an affiliate link. You can use my link, and we both get rewarded, I think, for that. And if you don't want to use my link, you can go to them directly by searching Coinly on Google. Now, if you're going to go for an accountant, you have to make sure of a few things. The first thing you need to look for is CTA. That means they're a chartered tax advisor, or you need to look for the letters ATT after their name on their firm website. fundamentally, you need to ask them if they've worked with crypto before, because from my experience, and I deal with this all the time with clients, because I actually help my own clients source these professionals to add professionals to their team to kind of manage their wealth moving forward. If they don't get crypto, or they don't get like what you're trying to achieve with your crypto portfolio, do not talk with them. The last thing you want is to be in a meeting with an accountant and they're kind of laughing at your vision for crypto and what you know and stuff like that. It's not worth it. These are not the right people to be around. Problem is it's very difficult to find the right people in the UK. There's very few vetted professionals that actually understand crypto and will understand you. So it's a whole thing. So you can either do it yourself with some software, or you can get some help. Both are very good options, just depends on what you're looking for. Which brings us to a big question. Can I see the data that HMRC has on me before I file my return? I think people are asking that question so they can see, if HMRC thinks you've made less, then you're going to pay less tax. And the truth of the matter is there's no portal, there's no way that you can see the data that HMRC have on you. It's kind of part of the thing where it's kind of like, it's like fear mongering, I think, part of it. That information is obviously for their system only, but the best way to know what HMRC have on you is to basically keep an audit of your own records yourself, because if you've done that accurately, that's going to be what HMRC see anyway of what you have. So just the best way to mitigate against it is to have your own records. And a few people have started to get a bit smart about it, about this kind of tax planning idea, about splitting holdings with a spouse. They've been asking, can I gift crypto to my spouse to reduce my tax bill? And yes, you can. You can actually gift crypto to a spouse to reduce your tax bill. But, and there's always a but, but actually let's get into the good stuff first. If you transfer some crypto to your spouse, HMRC will do you a favor, finally, something nice. The favor that they do is something called no gain, no loss, which basically means the crypto that you send to your spouse is treated at the price that you bought them. So it almost assumes that gifted amount was bought at the same price that you bought it. And what this means is if you send £3,000 to your spouse, they can now claim on their own tax bill that £3,000 of capital gains tax-free allowance. So as a partnership, you're now utilizing a £6,000 capital gains tax-free allowance instead of the £3,000 if you just kept it all to yourself. But later on, when your spouse comes to sell, they are treated as an individual and they will end up paying tax for their own crypto that you've sent them based on their own situation. So if you gift it, it doesn't erase the tax, but it does allow you to expand that capital gains tax-free allowance and also potentially spread out profits a little bit. So if we move on to question 13 here, people have been asking, is using crypto for gambling or even DeFi borrowing, for example, taxable in the UK? And there's a load of people that gamble in crypto, but also have this desire on a more serious note to take a loan out against your crypto in a DeFi environment. And yes, using your crypto in these ways can actually trigger tax events. So let's get a bit more into it. So if you use crypto to gamble, the moment you send that crypto to the casino or the online casino, whatever it is, that counts as a disposal. That counts as you actually having sold the assets. The problem is that losses in gambling cannot be claimed back as losses against your tax. So if you're going to gamble, don't lose, is the point. For DeFi borrowing, so borrowing against your assets, the loan itself is not taxed. So you're not taxed on the loan. But if your collateral actually gets liquidated because the price of the collateral actually drops, like it does in crypto from time to time, that does count as a disposal and you would owe tax on it. Also, the interest you pay on the loan or any income that you generate as a result of the loan will be taxed as normal. So really any gambling spends that you have are taxed. DeFi loans are not taxed unless you get liquidated, and that's just a terrible situation to be in. Which is why when I have clients that come to me about getting a loan against their crypto, I always proceed with a massive amount of caution. Some people just want to do it and they just do it anyway, and then I've got to kind of help coach them through that process of paying it back and all of that stuff. Some people are so adamant on doing that, but if someone doesn't have a loan right now and want to get a loan and come to me to ask me to help with all of that, I don't want to participate. It's not something I advise at all. And there's another question that people have been asking that strikes a real fear in people, and rightly so. Can HMRC freeze or seize my hardware wallet? So if I'm holding my crypto in a cold storage wallet, can HMRC seize my assets? Can they just go in and take them? And the truth is, HMRC can't just dive in and take assets, but they will do whatever they can using the legal means to restrict your access to them. Because ultimately they need your keys to get into your assets, but they can go to court and get orders to seize the hardware wallet itself. They could get information, they could freeze your bank account or even your exchanges so you can't off-ramp the crypto into your bank account. And so in practice, they go after all the places that they can control, but they're not going to go into your wallet and take the crypto out. And sure, the cold storage wallet might keep you safe from hackers potentially, but it's not going to keep you invisible to HMRC. And then also there's people who don't have just crypto, they have stocks and shares as well. And the big question is, does CARF, this new crypto asset reporting framework, also apply to my stocks and shares or just only crypto? It's in the abbreviation itself, CARF, Crypto Asset Reporting Framework. It only applies to crypto, so stocks and shares and bank accounts and other investments are already treated by other reporting frameworks. And so this is crypto only. And this whole update to CARF has been aimed purely at crypto, because up until now, they didn't really have a good view of what was going on in crypto. And of course, governments, tax agencies don't like not knowing what's going on. Now, all the questions for this video were extracted on my previous video's comments, so if you have any further questions about this topic, or any other topic for that matter, please put them in the comments. Your question might then be answered in an upcoming video. I urge you to share this video with any friends or family members that you have that hold crypto in the UK that are completely oblivious to all of this. Subscribe to this channel for more updates just like this. Stay emotionless, and I'll see you in the next one.